Ears. Listen carefully, because what you saw in that thumbnail was not exaggeration, it was a warning. The title says it clearly. They just passed it. Silver capital gains. Tax hits 39%. Bold red numbers. A warning arrow that was intentional. This is not a small policy tweak buried in paperwork. This is a shift that could directly impact your profits if you own silver in the United States. Before we go deeper, make sure you subscribe to Metal Market Insight right now, because this channel exists to protect investors like you from surprises that cost real money. By the end of this video, you will understand exactly what this 39% number really means for your stack, your portfolio, and your future decisions. Let's slow this down because headlines trigger emotion, but numbers determine outcomes. When people hear 39%, they assume the worst without understanding the mechanics. Here's the reality. Precious metals like silver are often treated under collectible tax rules, which already carry higher long-term capital gains rates compared to traditional stocks. Depending on your income bracket, that federal rate can climb significantly. When you layer state taxes on top, especially in high-tax states like California or New York, your effective tax burden can approach that alarming figure shown in the thumbnail. This means if you bought silver at $20 an ounce and sold it at $40, that $20 gain per ounce does not fully belong to you. A significant portion could go straight to taxes. That changes how investors calculate risk versus reward. But here's where it gets interesting and where most people stop thinking too soon. Why now? Why focus on silver gains at a time when inflation remains a concern, when national debt is at historic levels, and when industrial demand for silver and solar panels, electric vehicles, and electronics continues to rise? Is this purely about government revenue, or is it a sign that tangible assets are becoming more important in an unstable financial environment? When deficits expand and interest payments on debt grow larger, policymakers look for revenue sources. Investment gains are visible, measurable, and easier to target than wage adjustments. Selling silver is obvious on paper, making it a prime target for taxation. Think about behavior. If investors know that selling silver could trigger a heavy tax bill, some will hesitate to sell during rallies. Fewer sellers can tighten available supply in the secondary market, affecting premiums and dealer spreads. Ironically, a higher tax environment can encourage longer holding periods rather than rapid flipping, reshaping investor strategy. Let's put this into a practical American scenario. Imagine a middle-class investor in Texas who accumulated 5,000 ounces over several years at an average cost of $22. Silver rises to $42 during economic uncertainty. That is roughly $100,000 in gains on paper. Apply a high federal capital gains rate plus additional obligations, and suddenly tens of thousands shift from your pocket to the IRS. This is not theoretical, this is arithmetic. Cost basis tracking, holding period awareness, and structural planning matter more than ever. Understanding exactly what you own and when you bought it can protect you from giving away profits unnecessarily. Does this make silver unattractive compared to stocks or real estate? Not necessarily. Silver serves dual roles as an industrial metal and a monetary hedge. During periods of currency weakness or inflation spikes, it has historically seen powerful moves. The key difference now is that investors must evaluate after-tax returns instead of headline gains. Markets are driven by perception. When people see bold numbers like 39% in red with a warning arrow, it creates urgency and fear. Fear can either cause panic selling or disciplined planning. The difference depends on information, which is why we are breaking this down calmly instead of emotionally. Rushing into decisions without understanding bracket thresholds, holding classifications and legal structures like retirement accounts or trusts could cost you more than the tax itself. Knowledge and preparation are your strongest tools in this environment. Political cycles also matter. Tax frameworks shift over time. What is passed today can be adjusted under future administrations, but responsible investors do not base strategy on hope. They plan based on current law and stay adaptable. Adaptability separates reactive traders from long-term wealth builders. Do you actually know your silver cost basis? Have you organized your purchase records? Have you calculated potential gains at different price targets? Many accountants focus heavily on wages and stock portfolios, but have limited experience with bullion classification, and that knowledge gap can become expensive quickly. If you're still watching, you're already ahead of most people who ignore uncomfortable financial realities. Comment below and tell us, do you think this 39% capital gains ceiling will slow down silver investing in America? Or will it push more people to hold tighter and treat silver as long-term generational wealth? Your perspective matters and helps this community grow stronger. If you believe more investors need to understand what is happening, share this video with anyone who stacks coins, buys bullion, or thinks taxes only matter in April. By then, the decision has already been made, and your friends could miss critical planning time. The phrase, "they just passed." It was not designed to scare you. It was designed to wake you up. Policy changes do not send warning emails before they affect your profits. And whether silver rises to $50 or falls back to $25, taxation will shape your net outcome either way. Stay informed. Stay strategic. Here on Metal Market Insight, we do not just follow price charts. We follow the forces behind them. Awareness is not optional. It is protection. Understanding taxes, behavior, and market forces is how you safeguard wealth. Now let's focus on how to approach silver strategically. Planning long-term, understanding after-tax outcomes, and anticipating market psychology can give you an edge. Every purchase and sale must be evaluated through the lens of what you actually keep, not what appears on the paper. Even if silver moves quickly, the prepared investor knows the rules. A strong plan includes diversified holdings, cost basis awareness, and patience. This is not speculation. This is calculated investing in a high-tax environment. Understanding state and federal taxation is critical. Some high-tax states can push your effective capital gains rate dangerously close to 39%. Knowing where you're located, what brackets apply, and how to structure sales is essential. Behavioral economics also plays a role. Investors respond differently to fear. Some panic and sell, others stay disciplined and profit over time. Awareness of your own tendencies and market psychology can save thousands. Market behavior reacts to taxation. Tightening supply due to holding patterns can affect premiums and spreads. Even indirect consequences matter when planning your stack. Silver remains versatile. Industrial, collectible, and monetary roles overlap, creating unique opportunities. Those who evaluate after-tax returns rather than headline gains make smarter choices. Planning around legislation and political cycles ensures flexibility. Taxes may rise, fall, or shift forms. Staying adaptable prevents reactive losses. Track your purchases. Know exact cost basis. Evaluate each potential sale under current law. The difference between profit and loss often lies in meticulous record keeping. Community discussion strengthens understanding. Sharing perspectives, learning from peers, and engaging with other investors helps everyone make better decisions in complex markets. Alerts like "they just passed it" are designed to wake you up, not scare. Recognizing shifts in taxation and policy before making moves keeps your portfolio safe. Silver price swings will continue. The informed investor prepares for both upside and downside, knowing taxes will always shape net outcomes, not just market prices. Long-term wealth builders separate emotion from strategy. Understanding laws, psychology, and industrial demand creates sustainable growth. Even during rapid market moves, strategic holders focus on what they keep after taxes. Planning, patience, and awareness outperform reactionary trading. Every investor's situation is unique. Assess income, state taxes, and holding period classifications carefully. Seek expert guidance on bullion taxation to avoid costly mistakes. Your perspective matters. Share this video, comment below, and engage with others. Awareness spreads faster than panic, and knowledge protects your portfolio. The real question is not whether silver will move. It will. But whether you will be ready when it does. Subscribe, stay informed, and always plan for what you actually keep after taxes, because that is the bottom line. Metal Market Insight ensures you don't just watch markets, you understand them.